When it comes to mergers and acquisitions, one trend stands out year after year. Healthcare multiples consistently exceed those in most other industries. Whether you're evaluating private equity transactions, strategic acquisitions, or IPO-bound companies, the data is clear. Buyers are paying a premium for healthcare assets. But what makes healthcare so different? One primary reason healthcare multiples are higher is the stability of revenue streams. Dialysis clinics, oncology centers, and long-term care facilities operate on schedules patients cannot skip. Even in economic downturns, these services continue without major interruption, making cash flows predictable and less volatile. The United States is experiencing a demographic shift. An aging population and rising chronic conditions create decades-long growth. As baby boomers enter retirement, demand for assisted living and memory care is accelerating, reinforcing strong healthcare multiples. In healthcare, high barriers to entry protect established operators. Licenses, certifications, and capital-intensive infrastructure create defensible market positions. In certificate of need states, owning these licenses can be as valuable as the business itself, driving up multiples significantly. Healthcare remains one of the most fragmented industries, with thousands of small, independent operators competing locally. Private equity firms see enormous opportunity in rolling up these practices under corporate umbrellas. Consolidation achieves centralized functions, improved negotiation power, and better purchasing leverage, justifying higher multiples. Over the last decade, private equity has flooded into healthcare, attracted by predictable returns and defensive qualities. This competitive buyer pool creates bidding wars when high-quality healthcare assets come to market, pushing multiples even higher. Healthcare regulation actually acts as a stabilizer, with providers reimbursed under relatively stable fee schedules. This predictable revenue model makes lenders more willing to finance acquisitions, increasing buyer confidence and multiples. Healthcare business owners can maximize multiples by highlighting recurring revenue and demonstrating patient-based stability. Showcase barriers to entry, demonstrate scalability, and maintain compliance excellence to reduce perceived risk. Document operational efficiencies and show how your model can be replicated in new markets. While multiples can fluctuate, underlying drivers make it likely healthcare will continue commanding premiums for the foreseeable future. The healthcare sector offers structural advantages rather than temporary hype. Understanding these drivers helps make smarter strategic decisions. If you own a healthcare company and want to know what your business could fetch in today's market, let's have a confidential conversation. Don't forget to like, subscribe, and hit the bell icon to stay updated with Prime Exits M&A Advisory. For more insights and expert advice on healthcare M&A, and for a free valuation of your company, contact us today at valuations@pexits.com.